I want to start by explaining why I'm so fascinated with momentum strategies in Bitcoin. When I first encountered Bitcoin, I was struck by how much it moves, sometimes jumping or plunging double digits overnight. In markets like stocks or commodities, momentum has long been recognized. Once an asset starts moving in a direction, there's a good chance it'll keep going for a while. But Bitcoin takes that effect to another level, partly because it trades around the clock and partly because the market is still relatively young and less crowded with institutional players. In real-world terms, that means when Bitcoin shows a strong trend, whether up or down, a well-designed momentum system can often capture significant gains, or avoid big losses. Personally, I find this very appealing because a momentum-based approach can be simpler to code and test compared with, say, complicated machine learning algorithms, yet it still offers robust performance if you manage it properly. Let me walk you through how I think about building a Bitcoin momentum strategy, starting with the basic distinction between time series momentum and cross-sectional momentum. When I say time series momentum, I mean looking at the price history of a single asset, Bitcoin in our case, and betting that if it's been rising, it will continue rising, at least for a while, and if it's been falling, it will likely keep falling. This is different from cross-sectional momentum, where you look at a set of assets, maybe the top 50 cryptocurrencies, and rank them by recent performance, then buy the best performers and short or avoid the worst performers. Since Bitcoin is roughly half the entire crypto market by capitalization, I found that, as a standalone asset, a time series approach is often enough. But if you're managing a basket of coins, cross-sectional momentum can boost your returns by giving you exposure to whichever coins are trending at a particular moment. In my own research, I came across a paper that compared a moving average crossover strategy on Bitcoin against a Bollinger Bands mean reversion approach over the period from 2016 to 2021. What stood out was that, once realistic transaction costs were included, the moving average, momentum, strategy not only held up but tended to outperform in most longer timeframes. In other words, buying when the shorter-term average crossed above the longer-term average, and selling when it crossed back below, yielded better risk-adjusted returns. I also read another study from a UK university that used intraday data to show that early morning volume spikes often predicted whether Bitcoin would close higher or lower by the end of the day. In practical terms, that means if heavy buying happens right after the Asian markets open, that momentum often carries through until the US markets open. When it comes to constructing my momentum signals, I have a few favorite tools. First, moving averages. A simple example I like is the 10-day exponential moving average, EMA, versus the 50-day EMA. Exponential moving averages give more weight to recent prices, so they react faster to new information than simple moving averages, SMAs. That responsiveness is important in Bitcoin, because the market can shift so quickly. When the 10-day EMA crosses above the 50-day EMA, I interpret that as a bullish sign, so I go along. When it crosses back below, I exit. In my backtests on daily BTC, USD data, I found that the 14-period EMA versus the 50-period EMA was a particularly sweet spot, fast enough to capture most moves, but not so fast that it kept flipping during minor pullbacks. If I were trading on an hourly or 4-hour chart, I might shrink those lookbacks to something like a 12/26 MACD or 20/50 EMA, because intraday momentum cycles are shorter than daily ones. Next, I often layer in the Relative Strength Index, RSI. RSI measures the speed and change of price movements, oscillating between 0 and 100. Traditionally, traders associate levels above 70 with overbought, strong but potentially overextended, and below 30 with oversold, weak but possibly due for a bounce. In my setup, I don't blindly buy whenever I see an EMA crossover. I prefer to see the RSI above, say, 50, indicating that momentum is actually picking up. Sometimes I set a stricter filter, only entering when RSI is above 60, just to reduce false breakouts. I also watch for RSI divergence. If price makes a new high but RSI doesn't, that hints that the momentum behind the price increase is weakening, prompting me to tighten stops or even take profits early. The Moving Average Convergence Divergence (MACD) indicator also plays a role for me, especially on shorter timeframes. MACD is basically the difference between two EMAs, commonly 12 and 26 periods, and then a signal line which is itself a 9-period EMA of that difference. When the MACD line crosses above the signal line, that's bullish. When it crosses below, that's bearish. Because the MACD lags a bit more than a simple 2 EMA crossover, it's double smooth. I treat it as a confirmation tool rather than the primary entry trigger. If my EMA crossover says, go long, but the MACD is still below its signal line, I might wait for that MACD confirmation before pulling the trigger. Another useful metric is the rate of change, ROC, which simply measures the percentage change between today's price and the price, and, periods ago. It's very intuitive. If ROC is plus 2% over 14 days, that tells me Bitcoin's been gaining at an average rate of roughly 0.14% per day. In my testing, combining ROC with a simple moving average filter yields surprisingly clean signals. For instance, if ROC 14 is positive and price is above its 20-day moving average, that often indicates a healthy uptrend. And since ROC is easily interpreted as a percentage, I can set a rule like, only go long if ROC 14 greater than 0 and price greater than MA 20. When that condition breaks, I exit. It's a bit more straightforward than juggling multiple moving averages, yet still captures the core momentum idea. Volume is another dimension I never overlook. If a price breakout or moving average crossover happens on low volume, I treat it with suspicion. But if it happens on volume in, say, the top 25% of the last 50 days, that gives me more confidence that the move is genuine. In fact, some intraday studies show that volume spikes in the first half hour of trading strongly predict momentum for the rest of the day. So if I see a 3% jump in price during the first half hour accompanied by a volume spike well above average, I'm quicker to jump in and ride that wave. Conversely, if volume is anemic, I might skip the signal or reduce my position size. Once I've nailed down my indicators, the real work begins, backtesting. In crypto, data can be messy, timestamps can be off, different exchanges show different price feeds, and sometimes candles have gaps. I usually grab cleaned, aggregated data from a reputable provider, but I still cross-check against individual exchanges like Binance or Coinbase Pro. I align everything on UTC candles, so there's no confusion with daylight savings or local exchange times. Before calculating any moving averages or RSI, I make sure I have a continuous, gap-free series. Transaction costs and slippage are huge in this market. While stocks often have a few cents of spread, Bitcoin can have 0.1% CENT 0.25% maker-taker fees, and slippage can easily eat another few tenths of a percent if you're not careful. In my backtests, I assume a 0.25% fee on entry and 0.25% on exit, so a 0.5% round-trip cost, and I also model slippage as another 0.25% to be conservative. If I'm trading with more capital, like $100,000 or more, slippage can be more than that, so I adjust upwards. That way, when the backtest shows a 20% annual return, I know it's not a pipe dream because I've already factored in the real costs of executing trades. I'm obsessive about avoiding look-ahead bias, too. That means when I compute the 50-day EMA on day T, I only use data through day T, not day T plus 1. Even in a backtest, it can be tempting to peak at the next day's close when smoothing. I also test my strategy on multiple exchanges' data. If my profitable result only shows up on aggregated data but not on any single exchange, I know it might be an artifact of how the aggregated feed fills in gaps. To guard against overfitting, I split my data into in-sample, training, and out-of-sample, testing, periods. For example, I might optimize parameters from January 2017 through December 2019, then test them on January 2020 through December 2021. Then I do a walk forward, re-optimize parameters on 2018 to 2020, test on 2021, and so on. Only once I'm happy that parameters are relatively stable, meaning small tweaks don't dramatically change performance, do I consider deploying live capital. Once the backtests are promising, I turn to risk management. This is where a lot of momentum traders trip up. Momentum can catch big moves, but it can also whipsaw sharply when volatility is high. My first line of defense is position sizing based on volatility. I calculate a 14-day historical volatility by taking the ATR, average true range, over the past 2 weeks and dividing by the current price. That gives me a daily volatility estimate. If my target is, say, a 10% annualized portfolio volatility, I convert that to a daily target, around 0.63%. Then I set my position size equal to 0.63% daily volatility. So if Bitcoin's 14-day volume is 4% on a particular day, my position size would be 0.63%, 4%, equals 0.1575, meaning I buy Bitcoin worth 15.75% of my portfolio. If volatility jumps to 8%, my position drops to around 7.9% of my portfolio. This automatic scaling protects me from huge swings by dialing back exposure when things get jittery. If you're trading with a smaller account or limited leverage, you can instead do a simple fixed fraction approach, e.g., never risk more than 2% of your account on any single trade. Both work, but volatility scaling usually gives smoother returns. Stops are another essential layer. Even though my EMA crossover or ROC crossing below zero or RSI divergence can serve as exit signals, I don't rely on them alone. Bitcoin can drop 10%, 15% in an hour during a flash crash, and by the time a daily close triggers an exit, I could be underwater by 10%. So I use an ATR-based trailing stop, typically 2 times ATR, 14, on daily bars. That means if I enter long at $50,000 and the 14-day ATR is $4,000, my initial trailing stop is $50,000. 2 times $4,000 equals $42,000. As Bitcoin rallies, that stop moves up by 8,000 points. 2 times ATR, below the highest high since entry. If price ever touches that level intraday or at the close, I liquidate. That way, normal daily swings can occur without stopping me out, but if there's a real reversal I'll get out before it becomes catastrophic. I also set a hard drawdown limit. If my total P&L drops more than 15% from peak, I close all positions and halt new entries for a week. That prevents me from doubling down in a panic, which so many traders do when they see their equity curve plunging. A week is usually enough time for volatility to subside. After that, I'll review and only resume trading if conditions look favorable again. Without that rule, a single vicious market move, like the infamous March 2020 crash when Bitcoin fell nearly 40%, could wipe out months of gains before my system even had a chance to respond. Once my rules are defined, indicators, filters, position sizing, stops, I move to implementation. For data, I usually pull daily OHLCV, open, high, low, close, volume, from 2 or 3 sources. Often a direct exchange API, like Coinbase Pro, for real-time data, and a cleaned, aggregated feed like Coin API or Kaiko for historical testing. I align everything on exact daily UTC candles so there's never confusion about when a day starts or ends. If I trade intraday, say, 4-hour bars, I make sure I'm getting data aligned to 0000, 4 o'clock, 8 o'clock coordinated universal time, and so on. That way I know my signals match what I'll see on the exchange. For executing trades, I use CCXT in Python. It's a library that lets me connect to dozens of exchanges with a unified interface. I wrote a simple module that, given a target position size and a signal to buy or sell, places a limit order at the best bid or ask, sometimes a few basis points above or below to ensure execution. When Bitcoin volatility is low, I'm happy to wait for my limit to fill. When volatility is high or a signal is urgent, say, my EMA crossover flips right at 0000 coordinated universal time, I place a marketable limit order that's just a few ticks away from the best price, knowing that slippage will be minimal at that moment. After each trade, I log filled size, fill price, slippage, executed price minus mid price at order submission, and timestamp in a PostgreSQL database. That way, I can track exactly how my live performance compares to my backtests. To illustrate how this plays out in the real world, let me talk about the TRAKX Bitcoin Momentum Index, which launched in late 2023. This product is a smart beta basket that uses a volatility-adjusted momentum score to allocate across a dozen or so major cryptocurrencies, with Bitcoin usually getting the largest weight. While they don't disclose all their proprietary details, we know they rank each coin's 3-month momentum, percentage gain over 3 months, and then normalize that by 3-month volatility. They then pick the top half of the coins and allocate weights inversely to volatility. If Bitcoin's normalized momentum score is high, it might get, say, 40 to 50% of the index. If it's lower than other coins, its weight might be 20 to 30%. They rebalance once a month to avoid excessive turnover. Over the first 2 years of their live performance, 2022 through 2024, this demonstration index outpaced a simple Bitcoin buy and hold by about 10% annualized, and they reported 20% lower volatility because when Bitcoin's volatility surged, their algorithm trimmed its weight. From my perspective, the lesson is clear. Even if you're only trading Bitcoin, you should think about momentum normalized by volatility and consider a slower rebalance cadence. Maybe once a month instead of once a week or day, to reduce trading costs. Of course, nothing is perfect in crypto. One controversy often raised is the risk of overfitting. Bitcoin's price exploded in late 2017, and if you optimized your strategy only on 2016 to 2018 data, you might think a 14/28 EMA crossover is golden. But in the 2022-2023 bear market, that same 14/28 setup would have whipsawed constantly, eroding returns. To guard against this, I insist on testing across multiple regimes: bull, bear, sideways. I also run my optimized parameters through walk-forward testing. For example, optimize on 2017 to 2019, test on 2020. Then slide the window to 2018 to 2020, test on 2021, and so on. If the best parameters change wildly each time, that's a red flag. I want to see a stable range. If every re-optimization gives me lookbacks between, say, 10 to 20 for the short EMA and 50 to 100 for the long EMA, I know my strategy isn't just chasing noise. Liquidity and market impact are other hot topics. Bitcoin is the most liquid crypto by far, yet if I try to buy $5 million worth in one go, I'll undoubtedly move the market. For me as a retail or semi-pro trader, my order sizes are usually in the tens of thousands to low hundreds of thousands, so I can use limit orders without causing big ripples. But if you're trading with a large fund, you need to break your orders into smaller chunks. Perhaps use an execution algorithm that looks at order book depth and time-weighted average price, TWAP, over 30 minutes to achieve a better average entry. Otherwise, your backtests that assume low slippage will be overly optimistic. Bitcoin's market, though, is not just about risk of slippage. It's also about sudden regime shifts. Regulatory news, like a US ETF approval, can spark massive one-day moves. Or an exchange hack or a big whale selling can trigger a cascade of liquidations. I remember thinking in May 2021, when Bitcoin fell from $60,000 to $50,000 an hour, that any pure momentum trader without emergency stops got slammed. So I built a crash detector into my system. If the 5-minute return is worse than, say, -8% and the 5-minute volume is in the top 1% of the past month, I immediately flatten my position and halt new entries for 24 hours. That simple rule has saved me from getting trapped in fast-moving flash crashes when my daily indicator-based exit might not have triggered yet. Another criticism leveled against crypto momentum is the idea of crowding. If thousands of traders follow the same 10-day, 50-day EMA crossover, they all enter at roughly the same time and amplify the price move. Then when the crossover flips, they all exit together, deepening the decline. This collective behavior can cause sharper drawdowns than a lone trader would experience. To mitigate this, I sometimes introduce a tiny bit of randomness into my lookback windows. Say, 9-11 periods for the short EMA and 48 to 52 for the long EMA. So I'm not mechanically keyed into the exact same signals as everyone else. It sounds minor, but if you spread your signals across a range, you're less likely to suffer at the same moment that the entire crowd hits. Sell. If you liked the video, subscribe and like and wait for the second part of my story.